Welcome to the deep dive. We're here to cut through the usual market noise and really get you well informed on fascinating companies. And today, we're tackling one that presents a really interesting paradox right at the heart of the U.S. insurance world. Cincinnati Financial Corporation, ticker CINF. When you start to dig into CINF, you pretty quickly find it's driven by two engines that seem almost contradictory. On one hand, you've got this deeply conservative operational strategy, very traditional insurance thinking. But then on the other hand, they pair that with this surprisingly aggressive investment philosophy, heavily weighted towards equities.
Yeah, it's quite the contrast. It really is.
It's almost like picturing, I don't know, a really meticulous chess grandmaster, super careful during the day. But then with the money they won, they're playing high-stakes poker at night. It's that kind of vibe.
That's a pretty good analogy, actually.
So the big question we want to explore today is, how do these two really distinct, often kind of opposing forces not just manage to coexist, but actually drive CINF's success and define its unique place in what's a super competitive insurance landscape?
Well, fundamentally, CINF is a major property and casualty insurer, a P&C insurer. And their commitment to their independent agency distribution model, it's not just talk, it's almost old school in its intensity. It's central to them.
Right. But the thing that really makes them stand out, and something we'll definitely get into, is that dividend king status. Now, for those of you who follow dividends, you know, dividend king isn't just hype. It means they've increased their dividend for, what is it now, over 60 consecutive years?
63, actually, through 2023. It's remarkable.
63. That's just, it's a massive achievement in any industry, but especially in insurance, which can be pretty cyclical, right?
Absolutely. It speaks volumes about their financial strength and, importantly, their priorities over decades.
So our mission for you today, our listener, is really to unravel CINF's unique business model. We want to dissect its financial performance, warts and all, and explore how they strategically navigate the, let's face it, complex challenges of the modern insurance industry. We want you to walk away with a clear, detailed understanding of what makes CINF tick, its main strengths, its key risks, and, what the future might hold.
And we'll definitely be digging into that unique agency model, like you said, understanding the real impact of that equity-heavy investment strategy, analyzing how they actually manage underwriting profitability day to day, especially now, and finally, looking closely at their capital allocation approach. How do they manage their cash to support that legendary dividend? It's a company of real contrasts, as you said, and getting your head around that strategic tension between those contrasts, that's absolutely key to understanding their long-term success and, frankly, why they're different.
Okay, so let's jump right in. Cincinnati Financial, first and foremost, P&C insurer. We've established that. And that strategic focus on the independent agency model, it's not just one way they do business. It's really seen as their main competitive moat, right? Their big defensive advantage.
That's exactly right. It's foundational.
And of course, that dividend king status, those 63 years of increases through 2023, is just incredible financial discipline on display.
It really is. And what's so interesting, as we touch on, is how this deep operational conservatism, and you see it clearly, right? Meticulously managed balance sheet, very low financial leverage, consistently high financial strength ratings from AM Best and others. How that clashes almost with this unusually aggressive investment strategy. They hold a really significant slice of their investment portfolio in public equities, and it's even somewhat concentrated in certain names.
So it's not just equities, but concentrated equities.
Correct. And this isn't an accident. It creates this fundamental tension, a deliberate push and pull in their overall risk profile. And it's really crucial for you, the listener, to grasp that this tension isn't some kind of design flaw. It's absolutely central to CINF's character. It's a core part of how they generate returns over the long run.
It's almost like they've deliberately engineered this dual personality. Imagine that company again. The seasoned chess player in its core insurance business. Thoughtful, methodical, really risk-averse, always thinking moves ahead. But then, with the surplus cash that same careful company generates, it's playing high-stakes poker in the stock market, looking for those big wins.
It captures it well.
That's CINF in a nutshell, and it's just a fascinating balancing act. Few companies even try it, let alone sustain it for decades like they have.
Right.
And this unique blend, this caution in underwriting and boldness in investing, it really sets the stage for understanding their specific, almost counterintuitive competitive edge. It's fundamental.
Okay, let's unpack this agency model then. Like you said, it sounds almost like a throwback, doesn't it, in our super digital age? But the numbers, their whole history, suggest it's a powerhouse. They're building deep trust, not just chasing clicks.
Precisely. CINF's defining characteristic is its full commitment to the independent agency channel. That's their phrase, and they mean it. They are absolutely unique in that they don't sell directly to consumers at all. Zero direct sales.
Wow, none.
None. They rely exclusively on this extensive network of independent agents. End of 2023, that was, what, 2,080 agency relationships, over 3,100 reporting locations across 46 states?
That's a huge human footprint on the ground. It is, and their philosophy is genuinely person to person. It's more than just a slogan for them. CINF empowers a large team of local field associates, these are actual CINF employees, out in the field, embedded with the agencies. And these folks have the authority to make critical underwriting and claims decisions right there on the ground.
So decentralized decision-making, close to the action.
Exactly. This local presence and authority mean they can provide really high levels of service, quick responses, and tailored decisions for their agency partners. And that builds incredibly deep trust and loyalty over time. Decades in many cases.
So that's the moat.
That's the primary competitive moat, yes, because it gives them access to higher quality business, often more profitable business. That's just really hard for the big direct-to-consumer carriers with their giant ad spends and online focus to even touch, let alone replicate consistently. It's about relationship capital.
And you mentioned numbers supporting this.
Yeah, the data is compelling. CINF's average market share within its own network of agencies is around 4.6%, which is decent. But get this, that figure more than doubles to 9.2% for agencies that have represented CINF for over a decade.
Hubbles. Okay, that's significant.
It really is. It vividly illustrates the power of those long-term relationships and the potential they still have to deepen penetration, get a larger share of the business within their loyal agent network. It shows that loyalty genuinely pays off. For the agents, yes, but definitely for CINF too, through better, more profitable business.
Okay, but surely there's a downside to this model. It sounds expensive.
There is a trade-off. It's definitely a bit of a double-edged sword. It inherently means a higher cost structure. You have to support that large field staff, all those local associates, plus pay agent commissions. So naturally, that contributes to a higher underwriting expense ratio compared to the direct writers who run leaner, more centralized, often digital-first operations.
Makes sense. And technology adoption.
That's the other potential risk. This traditional relationship-first approach could lead to slower adoption of cutting-edge tech compared to, say, the insurtech startups who build their whole business around digital efficiency and AI. It's a deliberate trade-off CNF makes. They've clearly decided the deep relationships and the quality of business they get are worth that higher expense base and maybe a slightly slower tech curve.
All right, let's dive into their actual business mix, because that influences their risk profile quite a bit, right? Especially the heavy weighting towards commercial lines.
Absolutely. If you look at their 2023 net written premiums, that's basically their revenue from insurance policies sold. Commercial lines were the biggest chunk by far, 51.5%.
Half, okay.
Yeah. Then personal lines, that's home and auto for individuals, made up 27.4%. Excess and surplus, or E&S lines, think more complex, harder to place risks, that was 6.8%. Life insurance, a smaller piece, at 4.3%. And then there's another category, about 10.0%. And that's quite interesting because it primarily includes their reinsurance operations.
Reinsurance, so insuring other insurance companies.
Exactly. Through subsidiaries like Cincinnati Re and Cincinnati Global Underwriting Ltd., it gives them a footprint beyond just writing direct policies in the U.S., a bit of global diversification.
Okay. So with over half the business in commercial lines, what does that mean for CINF's performance?
It means their core results are highly sensitive to the overall health of the U.S. economy, and also to the specific commercial P&C pricing cycle, whether rates are going up or down. Unlike some peers who are maybe heavily focused on personal auto, CINF's fortunes are more directly tied to things like, our business is expanding? Is construction activity strong? Are employment levels healthy?
Because those things drive demand for commercial property liability, workers' comp.
Precisely. And this specific exposure also makes them particularly susceptible to something called social inflation.
Yes, you mentioned that earlier. Explain that a bit more.
Sure. It's this ongoing kind of creeping trend of increasing litigation costs. Bigger jury awards and liability cases, broader definitions of who's liable for what. It's been a really significant headwind for commercial casualty insurers across the board, pushing claims costs up beyond just standard economic inflation.
Got it. So understanding this heavy commercial lean is key to understanding their underwriting results and how they're exposed to these bigger economic and social trends.
Exactly. And that other category with the growing reinsurance arm, while smaller now, provides a subtle but important diversification buffer against some of those domestic cyclical pressures. It hints at a potentially broader future strategy, too.
Okay, let's zoom out now. Look at the bigger picture.
Yeah.
Because CINF doesn't operate in a bubble, right?
Yeah.
The whole P&C industry landscape matters.
Absolutely. And it's a really complex, dynamic environment right now. Industry-wide profitability is actually expected to continue into 2025, which might sound good, but the margins are projected to be much narrower than we've seen recently. S&P Global, for instance, is projecting an industry combined ratio of 99.2% for 2025.
Okay, remind us, combined ratio below 100% means profit on underwriting, right? Before investments.
Correct. So 99.2% is profitable, technically, but it's a razor-thin margin. Very little room for error or unexpected bumps.
So what are the main pressures creating that tight margin?
Well, what's fascinating here is how these powerful external forces create both immense pressures and significant opportunities. It's shaping the battleground for everyone, including CINF. The primary challenges are sort of twofold. First, you got persistent inflation. And it's both economic inflation, think higher costs for car parts, lumber for home repairs, medical treatments.
The stuff that directly hits claims costs.
Exactly. And then there's that social inflation we just discussed, litigation costs, huge jury awards. Both are relentlessly pushing claims severity higher, how much each claim costs. At the same time, you're seeing increasing frequency and severity of weather events.
Yeah, it seems like every year there are record storms, wildfires.
Right. Convective storms, derechos, hailstorms, wildfires, hurricanes. It's leading to record catastrophe losses year after year, it seems. And that's particularly straining homeowners insurance. S&P Global projects, the homeowners line specifically, will run at a big underwriting loss in 2025, maybe a 106.1% combined ratio industry-wide.
Wow, 106.1%. So for every dollar they collect in premium, they're paying out over $1.06 in claims and expenses, just on the underwriting side.
That's the projection. Before any investment income offsets it, it highlights the pressure.
Yeah, you think about the rising cost of rebuilding a home after a major storm, or these huge liability verdicts. These aren't just abstract numbers in a report. They hit an insurer's bottom line hard.
Very directly. It's like trying to price a product when your input costs are constantly shooting up, often unpredictably.
But you said there are opportunities too, tailwinds.
Yes, thankfully it's not all doom and gloom. There are significant offsetting factors. First, the industry has been in what's called a hard pricing market for several years now.
Meaning insurers have more power to raise rates.
Exactly. Because demand for insurance is still strong, and maybe underwriting capacity is a bit tighter after recent losses, insurers have been able to implement substantial premium rate increases across most lines. That helps offset rising claims costs. Second, the higher interest rate environment we're in now, that's actually been a big positive for insurers.
How so?
Because they hold huge portfolios of bonds and other fixed income securities. Higher rates mean they earn more investment income on that portfolio, and that income helps cushion underwriting volatility. And looking ahead, technology, especially AI, advanced data analytics, that's becoming a really transformative force.
For better risk selection pricing.
Yes, for more sophisticated risk selection, more granular pricing, more efficient claims handling. Companies that can really harness these technologies effectively, CINF included, stand to gain a real competitive edge in this tough environment. Hashtag TagTag 2.2, CINF's competitive position and market share.
Okay, so given this complex backdrop inflation, cats, hard market, tech disruption, where does CINF actually fit in? How does it stack up?
Well, it's definitely a significant player. They consistently rank among the top 25 P&C insurers in the U.S. based on net written premiums. So they're not small. However, context is important. They operate on a much smaller scale than the absolute giants of the industry.
Like State Farm or Progressive.
Exactly. CINF holds an overall P&C market share of around 0.82%. That sounds tiny, and it is compared to State Farm at over 10% or Progressive around 7%. There's a vast difference in scale.
So that 0.82% really highlights their position as more of a niche player, doesn't it? Not trying to be everything to everyone.
It absolutely does. Their competitive advantage, as we keep coming back to, isn't built on sheer size or blanketing the airwaves with ads. It comes from the depth and quality of those relationships within their chosen distribution channel, the independent agencies. Their strategy is explicitly to be the preferred carrier for a select group of high-performing agents, especially focusing on more complex, relationship-driven markets like commercial lines and high-net-worth personal lines.
So they deliberately avoid the really cutthroat, commoditized segments where the giants dominate.
Largely, yes. They pick their battles, allows them to leverage their service and relationship strengths.
And does the market share data show this targeted approach working?
It does. You can see it quite clearly. For example, CINF isn't even in the top 25 for private passenger auto, that super competitive, price-sensitive market. But they hold a much stronger #17 position nationwide in homeowners insurance with about a 0.92% share. Still small overall, but better penetration. And they maintain a solid presence in various commercial lines, like 1.32% share in total commercial auto. These are areas where specialized knowledge and agent relationships often count for more than just brand recognition or the lowest price.
Okay, so it reinforces that whole relationship moat idea that lets them thrive in specific profitable segments, even though they're much smaller than the household names.
Precisely. They're not trying to win every single battle. They focus on winning the ones that best fit their unique model and strengths. #tag 2.3 underwriting philosophy and risk management approach.
And underpinning that targeted strategy must be a specific underwriting philosophy, right? How do they decide what risks to take on?
Yes, their philosophy emphasizes disciplined, careful risk selection. The stated goal is always to be a consistent and predictable market for their agents. What that means is they don't want to jump into a market when times are good and then quickly pull back when things get tough. They aim for stability through the entire insurance cycle, both soft markets and hard markets. Agents value that predictability.
And how do they manage the risks they do take on?
Well, this isn't just a less philosophy. It's backed by a formal enterprise risk management framework, ERM. And this framework explicitly focuses on diversification, diversifying risk across different product lines, across different geographic regions to avoid too much concentration in one area, and even within their investment portfolio, despite its equity focus. It's an integrated approach. They try to look at risk holistically across the entire company, not just in silos.
And that conservatism extends to their balance sheet too, I gather.
Mhm.
Low debt.
Very much so. They maintain a very low reliance on debt, which is a key sign of financial prudence, especially for a financial institution. Their debt-to-total capital ratio was only 6.3% at the end of 2023. That's remarkably low. It gives them a huge cushion.
And what about those big, unpredictable catastrophe risks, like a massive hurricane?
To manage that volatility, they strategically cede or pass on a significant portion of their peak risk through reinsurance. They buy comprehensive property catastrophe and casualty reinsurance programs every year. This effectively transfers some of the financial burden of a truly enormous event to other companies, the reinsurers.
Like a safety valve.
Exactly. It protects their own balance sheet from the full, potentially devastating impact of a major catastrophe. It smooths out the bumps.
Okay, but this brings up that question again. If they're so prudent, operationally careful underwriting, ERM, low debt, reinsurance, why do their reported earnings jump around so much?
Ah, yes. It points directly back to that fundamental tension we started with, the aggressive investment strategy. While the core insurance operations are indeed managed very conservatively, that investment side, with its big equity allocation, introduces significant market-driven volatility. And that volatility often overshadows the underlying stability of the insurance business when you just look at the headline GAAP earnings number.
So the operational prudence is key to their stability and that amazing dividend.
Absolutely key.
But to really get the full financial picture, you absolutely have to look at both engines, the steady underwriting and the more volatile investments. You can't just look at one.
You have to understand how they interact. That's the core of understanding CINF.
All right, this is where it gets really interesting, isn't it? Because when you dig into CINF's underwriting performance, you see these two distinct stories playing out, often pulling in different directions.
That's right. Their overall consolidated GAAP combined ratio, that key measure of underwriting profit, was 94.9% in 2023. Now, that was an improvement from 98.1% in 2022, so moving in the right direction, though it's still a bit higher than the exceptionally strong 88.3% they hit back in 2021.
So profitable overall on the underwriting side in 2023. But you're saying that number hides some internal drama.
It does hide a significant divergence between their main business segments, especially when outside pressures like catastrophes hit hard. Let's take the second quarter of 2025 as an example. Their commercial lines and their E&S segments, they delivered excellent results, combined ratios of 92.9% and 91.1% respectively. Very profitable.
Okay, strong performance there.
Very strong. Shows good underwriting, risk selection, favorable pricing in those markets, are consistently making money there. But in stark contrast, during that same quarter, their personal line segment recorded a combined ratio of 102%.
102%. So an underwriting loss in personal lines.
Yes. And that loss was almost entirely driven by catastrophe losses, storms, hail, etc. Cat losses added a massive 23.8 percentage points to the personal lines combined ratio just in that one quarter.
Wow. So one part of the business is getting hammered by weather, while the other part is humming along nicely.
Precisely. It vividly shows how localized weather events can disproportionately whack one segment while the others remain resilient.
It's like that machine analogy again. You've got this finely tuned engine, two main pistons driving the core insurance business. One piston commercial and E&S is firing perfectly. Smooth, efficient, generating consistent profit.
Right.
The other piston, personal lines, keeps hitting snags. Sputtering sometimes, mainly due to external impacts like hailstorms or hurricanes hitting their geographic footprint in the Midwest and Southeast.
That's a good way to visualize it.
And the key insight seems to be that the strength and consistency of that commercial piston often ends up subsidizing or at least allowing CINF to absorb the volatility and occasional losses from the personal lines piston.
That operational counterbalance is critical to their overall stability, just as critical in its own way as the investment strategy.
And it's also worth noting, you said their underwriting expense ratios stayed pretty stable, around 30.8% in 2023.
Yes, that indicates they maintain consistent operational cost control, even when claims costs are bouncing around due to those external factors. They manage their own controllable expense as well. Okay, so that brings us neatly to the second, and very different, engine in CINF's dual-engine model. CINF generates significant value not just from insurance, but also from this actively managed and, yes, aggressive investment portfolio. End of 2023, it was valued at a hefty $24.8 billion. And the crucial part is its asset allocation, significantly more aggressive than many P&C peers.
How aggressive are we talking?
A notable 42.9% in common equities, stocks, and 55.7% in fixed maturity securities, mostly bonds. Many insurers would have a much lower equity weighting.
Almost 43% of stocks.
Exactly.
You didn't mention concentration, too.
Yes, the equity portfolio is also quite concentrated, adding another layer of specific stock risk. The top 5 holdings made up 28.2% of the publicly traded common stock portfolio, and just one stock, Microsoft, represented a significant 7.9% of that public equity slice.
Wow, nearly 8% in Microsoft alone.
Yeah.
That's a concentrated bet for an insurance company portfolio.
It is, and it's a very deliberate strategy. The goal is to boost long-term total returns beyond what they could get from just bonds.
But, as you'd expect, this equity-heavy, concentrated approach must introduce a ton of volatility into their reported results, right? Their GAAP earnings and book value.
Oh, absolutely. Significant volatility. Just look at the recent past. In 2023, they recognized $1.1 billion in pre-tax net investment gains. That was a primary driver of their reported net income for the year. Looked great on paper, but that followed 2022, where they experienced a massive $1.5 billion pre-tax net investment loss on that same portfolio, and that drove a net loss for the entire company that year.
That's a $2.6 billion swing just from the investment portfolio in 2 years. It's huge.
It's enormous, and it highlights the impact.
So for a company that prides itself on being operationally conservative, consistent for its agents, does this aggressive investment volatility ever create internal tension or pressure on the insurance side? How do they manage that disconnect internally?
That's a really perceptive question, and the company is actually very intentional about how it frames this, both internally and externally. The volatility from the equity portfolio, specifically those unrealized gains and losses from market movements, is acknowledged. It's understood as part of the long-term strategy. But crucially, you must differentiate that market value volatility from the stable income generated by the investments themselves.
Oh, okay. So the value swings wildly, but the dividends and interest payments are more predictable.
Exactly. While the market value of the equity holdings can jump around dramatically based on stock prices, the consistent pre-tax investment income, the cash coming in from bond interest and stock dividends, tells a much steadier story. That income stream grew a healthy 14% to $894 million in 2023, and it kept growing, up 18% year over year in Q2 2025. This reliable, growing income stream provides a vital offset to the cyclicality and volatility of the underwriting business. It's the stable bedrock underneath the market-driven swings in the portfolio's value, and it's absolutely critical for funding that legendary dividend.
Okay, so when we look at CINF's reported profitability metrics, like return on equity, ROE, they bounce around like crazy, largely because of that investment volatility we just hammered home. Like ROE was amazing in 2021, over 22%. Then it crashed to negative 4.6% in 2022,
Yeah.
then back up to over 15% in 2023.
Huge swings.
Massive swings, and they can be really misleading if you don't know what's driving them. So for you, our listener, trying to understand the fundamental health of this insurer, what's the key takeaway here? How do you cut through that noise?
Yeah, if we connect this back to the bigger picture, for anyone trying to understand the fundamental health here, it is absolutely critical. I can't stress this enough to look beyond those headline numbers. You have to understand what drives the core cash generating power versus these market-driven fluctuations. Because GAAP net income, and therefore that headline ROE figure, includes all those unrealized gains and losses from the big equity portfolio.
Which are non-cash items.
Exactly. They're non-cash. They don't necessarily reflect actual money coming in or going out. They're just accounting entries reflecting Mr. Market's mood swings. So GAAP net income is often a poor indicator of the core operational health of the insurance business itself.
So to get that clearer, more stable picture, you need to look elsewhere, like non-GAAP operating income.
Precisely. You need to look at non-GAAP operating income. Let's use Q2 2025 again. Reported GAAP net income was a huge $695 million, mostly boosted by those investment gains. Looked fantastic. But the non-GAAP operating income, which strips out those non-cash, often volatile investment market fluctuations, was more modest, but still very strong, $311 million.
Okay, so that $311 million gives you a better sense of the profit from actually selling insurance and collecting dividends interest.
Exactly. Analyzing returns based on that operating income provides a much clearer, much more consistent view of the true profitability of CINF's core underwriting activities and its stable investment income generation. It helps you separate the real operational performance from the transient market noise. It gives you a much better feel for their underlying sustainable earnings power. And digging a bit deeper into their overall financial health, CINF's accounting practices, at least in the core operations, seem quite conservative. It aligns with that careful chess player persona we talked about. A really key area for any insurer is setting aside enough money today to pay future claims. These are called loss reserves. CINF explicitly aims for prudent loss reserves, and historically they've often reported what's called favorable prior year reserve development.
Meaning they ended up needing less money than they originally set aside for claims from past years?
Correct. It suggests their initial estimates were cautious, maybe even a bit conservative, which is generally a good sign in insurance accounting. Better to over-reserve slightly than under-reserve. Furthermore, the actual insurance business itself has very low capital expenditure needs. Think factories or R&D labs insurers don't really have those big capital outlays. CINF's CapEx has consistently been less than 1% of their cash flow from operations over the last 3 years, 2021 through 2023.
So not much cash needed for buildings or equipment. Means more cash is free for other things.
Exactly. Which leads us back to cash flow.
Right. That analogy of the small business owner, the paper profits might swing with property values, but the cash in the till from daily sales is what really shows strength and pays the bills. That really clicked for me. So when we look at CINF's operating cash flow, the cash in the till, what does that tell us? Especially about their ability to sustain that dividend.
It tells us a lot. Because, as you noted, net income often diverges, sometimes massively, from the actual cash generated by operations. Remember 2022, they reported that big net loss of $487 million on paper because of investment losses. But in that same year, they actually generated over $2 billion in positive cash flow from operations.
Huge difference. Loss on paper, but $2 billion cash came in the door.
Precisely. That divergence happens mainly because net income includes those large, non-cash, unrealized investment gains or losses. Cash from operations, however, reflects the real cash generated by the insurance business premiums collected minus claims and expenses paid, plus the actual cash received from bond interest and stock dividends. That operating cash flow number is a much more stable, much more reliable indicator of their core earnings power and, crucially, their capacity to pay that dividend year after year.
Okay, that makes sense. The cash flow is the real engine.
It absolutely is. That substantial operating cash flow is the true financial engine of CINF. It's the rock-solid foundation for everything else, including the dividend. And it's also worth mentioning, CINF has a hugely significant off-balance sheet asset, something you won't find easily in the financial statements.
What's that?
It's the immense intangible value of that long-standing, deeply loyal network of independent insurance agencies. This distribution network, arguably their primary competitive advantage, a real barrier to entry for rivals, has been built over decades through consistent service, trust, relationship building.
But because it's intangible, it doesn't show up as an asset on the balance sheet.
Generally not under standard accounting rules, no. But its economic value is undeniable. It's a hidden asset in a way. And just a quick accounting note, they did adopt a new standard, ASU 2018-12, starting in 2023. It affects how they account for their long-duration life insurance contracts. Just something to be aware of if you're digging into the detailed financials. And importantly, the company states it has no undisclosed off-balance sheet liabilities, which adds a layer of transparency and reassurance for investors.
Okay, so let's tie this all together. What does it mean for you, the shareholder? Especially thinking about that incredible dividend king status, it sounds like the takeaway is, even when the stock market is having a meltdown and causing those wild swings in reported net income, CINF's dividend should remain pretty secure, right? Because it's backed by that solid, consistent cash flow from the actual insurance business.
That's the key message, yes. The underlying support is strong and much less volatile than the headline earnings suggest.
And that track record is just, frankly, exceptional. 63 consecutive years of dividend increases. That Dividend King Club is very exclusive. The annual dividend declared hit $3 per share in 2023, up from $2.76 the year before. And the current annualized rate is $3.48 per share. That gives a yield around 2.2%, depending on the stock price.
And the sustainability of that dividend is really the crucial point here. As we discussed, you absolutely have to assess it against their operating cash flow, not the volatile GAAP net income. Take 2023 again. P&C operations generated a robust $1.83 billion in cash flow. Against that, total cash dividends paid out during the year were about $474 million.
So the cash flow covered the dividend almost 4 times over.
Nearly 4 times, yes. That's a very comfortable coverage ratio. It really underscores the dividend security and shows it's robustly supported by the core operating cash flow. It's not dependent on market timing or selling appreciated stocks. That's key for dividend investors looking for reliability.
Okay. And besides the dividend, they also do share repurchases sometimes. Buy back their own stock.
They do, yes. It's part of their broader capital return strategy, but it's much more discretionary, more opportunistic than the dividend. The activity level fluctuates quite a bit. They spent $67 million on buybacks in 2023. Which was way down from $410 million in 2022. And interestingly, they didn't repurchase any shares in the second quarter of 2025.
So they're not just buying back stock constantly. They seem quite selective.
Very selective. This pattern points to a very clear, disciplined capital allocation hierarchy in practice. Priority number 1 for their capital is always to support the core underwriting operations, maintain financial strength, support growth, keep those high ratings. That's non-negotiable. Priority number 2 is funding that consistently growing dividend. That's a cornerstone of their promise to shareholders, something their long-term investors count on.
And only after those are covered.
Exactly. Only then, if there's excess capital remaining, do they consider opportunistic share repurchases. And they seem to do that primarily when management believes the stock is trading at an attractive discount to its intrinsic value. Perhaps when the market gets spooked by short-term earnings volatility or overlooks the underlying strength. So this approach really prioritizes that stable, growing dividend as the main pillar of shareholder returns, while keeping powder dry for smart, value-driven buybacks when the opportunity arises. Hashtag 4.2 management, corporate governance, and alignment.
Okay, what about the people running the show? Leadership, board oversight, that sort of thing. Good governance matters.
It definitely does. And CINF seems well structured here. They had a smooth, orderly CEO succession completed in 2024. Stephen Spray became CEO. And the former CEO, Stephen Johnston, stayed on as executive chairman, which usually helps ensure continuity and a smooth handover. That's generally seen as positive.
And the board itself?
The board of directors has 13 members. A substantial majority, over 69%, are independent, meaning they aren't part of management and have no other major ties to the company. That fosters objective oversight. They also have a strong commitment to diversity, with over 38% of directors being diverse based on gender or race. And recent appointments in 2024 and 2025 brought in fresh outside expertise in areas like management consulting and public accounting. That helps keep the board's skills current.
So structurally, it looks pretty sound. What about practices that promote accountability, making sure management is aligned with shareholders?
Yeah, these aren't just formalities. They have fundamental governance practices that really matter. Things like separating the chairman and CEO roles. That provides an extra layer of independent oversight on the CEO's decisions. They also have a strong independent lead director with clearly defined responsibilities. But maybe most impactful are the robust stock ownership guidelines they have, for both directors and executives.
Meaning they have to hold a significant amount of company stock themselves.
Exactly. The CEO, for example, is required to hold stock valued at 5 times their annual salary. Other top executives have to hold 3.5 times their salary.
5 times salary. Okay, that's significant.
It really is. These guidelines mean management's personal financial fortunes are deeply tied to the company's long-term stock performance. It directly aligns their motivations with yours as an investor. They truly have skin in the game.
That makes sense. And executive pay itself, how is that structured?
It's also carefully designed for alignment. The vast majority of executive pay is long-term and at risk.
Meaning it's not guaranteed, it depends on performance.
Correct. It's tied directly to specific, measurable performance metrics over multiple years, and it's delivered primarily as equity awards like stock options or restricted stock units. This structure ensures their pay directly rises or falls with the company's long-term success. It incentivizes sustainable value creation, not just hitting short-term numbers.
And are they diluting existing shareholders much with all these stock awards?
Actually, no. Dilution from employee stock-based compensation seems minimal. It was less than 1% of total shares outstanding as of early 2024. So they're managing that quite responsibly. It points to a well-run, shareholder-friendly compensation approach overall, hashtag 4.3 valuation context and comprehensive risk assessment. Okay, let's talk valuation. How does the market price CINF, given everything we've discussed? As always with valuation, it requires a bit of nuance, especially here, because, as we've really hammered home, their GAAP earnings are so volatile due to that investment portfolio. So looking at recent numbers, the stock traded at a trailing 12-month PE ratio of about 13.6x. Price to sales was around 2.1x, and price to book was 1.72x. But that PE ratio, honestly, it's historically unreliable for CINF. Because they've had periods of negative net income due to investment losses, the PE can become meaningless or just wildly misleading year to year.
Right. So for P&C insurers like CINF, you said price to book, or PB, is usually the better metric.
Generally, yes. It's considered the most standard and relevant valuation metric for the sector. Book value basically represents the net asset value of the company, and for insurers, their assets are mostly liquid financial instruments like bonds and stocks, so book value is a reasonably tangible measure. CINF's current TB ratio of 1.72x is actually a bit above its 5-year quarterly average, which was closer to 1.5x.
What might that suggest? Market seeing improvement?
It could suggest the market is recognizing the improved underlying profitability in their core insurance operations, that strong operating cash flow, and maybe a stronger overall capital position even with the investment volatility factored in. Perhaps less of a discount is being applied currently.
And how does that 1.72x PB compare to some of their peers?
Well, it really reflects CINF's unique risk and return profile. It's significantly lower than a high-growth, tech-savvy competitor like Progressive, which often trades way up at 4.4x PB or even higher. The market pays a big premium for Progressive's growth and returns. But CINF's PB is generally in line with, or maybe slightly below, other high-quality, more traditional peers. Think Allstate around 2.35x recently, Travelers at 2.07x, Chubb at 1.78x.
So kind of in the middle of that quality peer group.
Roughly, yes. It suggests the market is balancing CINF's strengths, that stable commercial business, the loyal agency network, the amazing dividend record against its challenges, particularly the higher catastrophe exposure in personal lines, and that earnings volatility from the aggressive investment portfolio. The market sees the value, but it applies a discount for those inherent swings and risks.
Okay, speaking of risks, let's summarize the key ones investors need to keep in mind.
Absolutely. A comprehensive analysis has to consider the risks. First, and perhaps most obvious for CINF, is catastrophic loss exposure. They have significant geographic concentration in the Midwest and Southeast. That leaves them highly exposed to natural catastrophes, severe convective storms, tornadoes, hail, wind, and hurricanes. This risk is the main driver of volatility and underwriting losses in their personal lines segment. We saw that clearly with the Q2 2025 example where cat losses blew out the combined ratio for that segment. They manage it with reinsurance, but the exposure is undeniably high.
Okay, number 2 must be investment market volatility. We've talked about this a lot.
We have, because it's crucial. That large, concentrated equity portfolio is a major source of financial risk, separate from insurance risk. A significant, prolonged downturn in the U.S. stock market would directly and materially hit the company's book value. And it would inevitably lead to large GAAP net losses, just like we saw starkly in 2022. This risk adds a substantial layer of market-correlated volatility to their overall results. It can be unsettling for investors who prefer pure insurance plays.
Then there's reserve adequacy and inflation, the risks they didn't set aside enough money for future claims.
Exactly. Like all P&C insurers, CINF faces this risk. Persistent economic inflation keeps pushing up the cost of car repairs, building materials, medical care. If that outpaces their pricing, reserves might fall short. And simultaneously, that social inflation trend, bigger lawsuits, broader liability interpretations, can dramatically inflate the cost of liability claims, often years after policies were written. If these trends are worse than CINF assumed when setting reserves and prices, they could face adverse prior year reserve development down the line, which hits future earnings and could potentially strain capital. It's a constant battle for insurers to stay ahead of inflation trends.
Competitive pressures too, right? It's a tough industry.
Always. Intense competition. CINF faces it from multiple angles. You've got the huge national carriers with scale, massive ad budgets, often more advanced tech platforms. They compete on price and brand recognition. But CINF also competes with smaller, nimble, regional carriers who might have really deep local knowledge and strong community ties, a different kind of challenge.
And finally, their biggest strength is also a potential risk: reliance on the independent agency channel.
It is in a nuanced way. While it's their core strength and moat, their success is completely dependent on maintaining those strong relationships and providing a compelling value proposition for the agents. If CINF's products, service levels, tech tools for agents, or commission structures fall behind what competitors offer, agents have choices. They could shift their clients' business elsewhere. That would directly hit CINF's premium growth and profitability. They work incredibly hard to prevent that with their person-to-person service model, but it's a risk that requires constant vigilance and investment in the agency relationship.
But let's put this in perspective. For investors worried about the absolute worst-case scenario, the chance of CINF actually going bankrupt seems incredibly low, doesn't it?
Extremely low, yes. Given CINF's conservative balance sheet overall, that very low debt level, and its consistently high financial strength ratings, remember, A+ superior from AM best, the company has a very robust ability to meet its obligations to policyholders. There's a strong safety net there. High financial resilience against the specific risks we've outlined. It's a stable ship, fundamentally, even if it navigates some choppy investment waters from time to time. Hashtag 4.4, adapting to a changing environment and future outlook.
Okay, so the world has definitely changed a lot recently. Persistent high inflation, rising rates, more frequent and severe catastrophes, that hard insurance market, the different playing field than maybe 5 or 10 years ago.
Yeah.
So how is CINF adapting? Are they just surviving these changes, or are they actively evolving to navigate these powerful currents?
They appear to be actively adapting, demonstrating both prudence and a willingness to make tough choices. Since around 2020, there's clearly been a heightened focus on underwriting discipline. They've been actively pushing through significant rate increases across their book. We're talking low double-digit hikes in personal lines, high single digits in commercial. They had to keep up with costs.
And is that showing results?
Yes. The tangible result is an improvement in their underlying profitability. Their underlying accident year combined ratio, that's the core profitability before cat losses or reserve changes, improved to a strong 85.1% in Q2 2025. That shows their fundamental underwriting is working well. They've also shown they're willing to actually moderate growth in particularly challenged markets, like reducing new business in parts of California if it means prioritizing profitability over just chasing premium volume. That takes discipline.
What about adapting to those climate-related risks, the increasing storms and fires?
They tackle that on multiple fronts. They use sophisticated catastrophe modeling software to better understand and price the risk and to manage their aggregate exposure in vulnerable areas. They buy those comprehensive reinsurance programs every year, as we discussed, to transfer a significant chunk of the peak risk. And they implement targeted pricing and underwriting actions in high-risk zones, essentially charging more or being more selective about the risks they take on in the most exposed areas.
And inflation. How are they navigating that persistent pressure?
Primarily through those aggressive but necessary pricing actions. They've worked hard to ensure their premium rates keep pace with the rapidly rising loss costs, both for property repairs and liability claims. It's been a major focus, and so far it seems they've been largely successful in staying ahead of the curve, judging by their underlying results.
Okay, and the big one, technology disruption. How does a traditional agency-based carrier like CINF adapt to the threat from direct writers and nimble insurtechs?
This is a constant challenge. CINF's strategy isn't really to try and beat the direct writers at their own game or to replace their agents with technology. Instead, their focus is on providing their agents with better technological tools to help the agents be more efficient, improve their own client service, quote, faster, and generally compete more effectively in the modern market. Empowering the agent, not bypassing them.
But does that carry a risk of falling behind? Compared to companies like Progressive, who seem to have tech and data analytics embedded in their DNA.
It absolutely carries that risk. Can they provide enough tech support to keep their agents competitive? Will they innovate fast enough? It's a persistent threat. They acknowledge the risk of potentially lagging peers who have a deeper, more ingrained culture of technological innovation. It's an ongoing strategic balancing act for them.
This really raises that important question, doesn't it? Can an agency-focused insurer like CINF truly keep pace with the tech giants of the industry in the long run? Or is their unique, relationship-heavy model its own form of sustainable competitive advantage, even if it looks different?
That's the multi-billion-dollar question, really. And the U.S. P&C market is the backdrop. It's mature, it's massive, over $1 trillion in annual premiums. And it's still growing, projected mid to high single-digit premium growth for 2025. CINF is primarily playing in that huge domestic U.S. market across 46 states. But they do have those smaller but growing international reinsurance operations, Cincinnati Re, Cincinnati Global Underwriting, that offers a little diversification, maybe a glimpse of future expansion vectors.
Any recent news tidbits worth mentioning?
Well, recent highlights include those strong Q2 2025 earnings we discussed showing underlying improvement. They routinely declare their quarterly cash dividend, reinforcing that commitment. And they appointed a new independent director back in June 2025, signaling continued focus on governance and fresh perspectives. Pretty steady as she goes, fundamentally. Hashtag tag outro.
So we've taken a really deep dive today into Cincinnati Financial Corp. And what emerges is this picture of a company that somehow manages to not just survive, but genuinely thrive by blending deep tradition with, let's call it a bold, sometimes volatile investment philosophy.
Yeah, that captures the essence of it.
Their unwavering, almost old-world dedication to that independent agency model. It's clearly not just lip service. It's a powerful competitive moat, building deep loyalty, giving them access to high-quality business. And underpinning it all, especially that dividend king status, are those conservative core insurance operations, generating that robust operating cash flow year in, year out.
Even while it's counterbalanced by that undeniably aggressive, equity-heavy investment strategy that creates all the headline volatility we talked about.
Exactly. You see how CINF navigates this dynamic, challenging world, relying on that loyal agency network, relying on the strong cash generation from the core business to secure that legendary dividend, allowing them to ride out market storms while still aiming for those higher investment returns.
It's a unique formula, for sure.
Okay, so here's a final thought for you, our listener, to mull over as we wrap up. You've seen how Cincinnati Financial thrives by blending this deep tradition with a bold, sometimes nerve-wracking investment approach. Given its strong cash-generative operations and that incredible commitment to the dividend, how might CINF continue to balance that unique investment strategy with the need for stable, predictable growth in its core insurance business, especially in a world that seems to be getting more dynamic and volatile, not less?
That's a good question to ponder.
And as technology keeps reshaping the entire industry, what might a future look like? Could CINF lean more heavily into its growing international reinsurance arm, maybe seeking more geographic and risk diversification? Or could they find new ways to leverage cutting-edge tech even more intensely to empower their agents, making them even more competitive, but without losing that deeply personal, person-to-person ethos that defines them?
Lots to think about there.
Definitely something for you to ponder or maybe explore on your own. Thanks for joining us on The Deep Dive.